You are watching a financial threshold being crossed in real time, not gradually, not quietly, but violently, in full view of anyone willing to look. In early February 2026, gold is trading near $5,000 per ounce after one of the most explosive rallies in modern financial history. Only weeks ago, it surged past 5,500, then it collapsed, then it rebounded again. These are not normal movements, these are convulsions. Silver, meanwhile, is behaving differently. It surged, crashed, rebounded, and yet something strange is happening beneath the surface. Traders who once treated silver as the faster, more aggressive cousin of gold are beginning to rotate back into gold. Positions are being reduced. Margin calls are forcing liquidations. Volatility is ripping through the silver market faster than through gold. This is not simply about metals. This is about the structure of the global financial system cracking under pressure. Now we need to talk about the first signal that something deeper is wrong. For decades, markets followed a familiar logic. When real interest rates rose, gold weakened. When the dollar strengthened, metals fell. When growth accelerated, industrial commodities rose, while defensive assets stagnated. That logic is no longer holding. Over the past year, gold has surged, even as equity markets in several regions remained resilient. Inflation has moderated in headline terms, yet real purchasing power continues to erode. Bond markets are unstable. Currency markets are swinging violently. And central banks, institutions that once quietly managed reserves, are now openly accumulating gold at record levels. When defensive assets rise at the same time as speculative assets, the signal is not prosperity, it is distrust. This brings us to the most dangerous signal of all, the divergence between gold and silver. Silver should be outperforming in a strong expansion. It is half industrial metal, half monetary metal. More than half of its demand comes from industry, solar panels, electronics, energy infrastructure. And yet silver is being shaken violently by margin hikes, forced liquidations, and speculative positioning. Exchanges have repeatedly raised margin requirements to contain volatility, forcing traders to post more collateral or liquidate positions. This is not a minor technical detail. It is a structural event. When leverage disappears, price discovery becomes brutal. The weaker hands vanish first. The smaller market, silver, feels the pain sooner. Gold, by contrast, is not just a trade. It is a reserve asset. Central banks are projected to buy hundreds of tons this year alone. That difference explains why gold traders are selling silver. Not because silver is worthless, but because gold has become something more than a commodity. It has become insurance against the failure of currencies themselves, and this is where we must confront the real cause. The modern financial system is built on debt: sovereign debt, corporate debt, consumer debt. For decades, growth was pulled forward by borrowing from the future, but now the future has arrived. Global debt levels have reached heights never seen in peacetime. Governments cannot meaningfully reduce deficits without triggering recession, and central banks cannot normalize rates without destabilizing bond markets. And investors know it. When debt cannot be paid, it is diluted. That dilution does not always appear immediately as consumer inflation. It often appears first in asset inflation. Stocks rise, real estate rises, commodities rise, not because they are becoming more valuable, but because the currency measuring them is becoming less trustworthy. Gold rose more than 60% in a single year, driven largely by central bank diversification away from the dollar and fears about sovereign debt sustainability. That is not a normal market trend. That is a vote of no confidence. This brings us to global confirmation. Look east. In China, retail demand for gold bars and coins has surpassed jewelry purchases for the first time in modern records. That is a psychological shift. Jewelry is consumption. Bars and coins are fear. In Lebanon, a country whose banking system effectively collapsed, the National Gold Reserve is being discussed as a last line of survival. Citizens, distrustful of banks, are turning to precious metals to preserve what remains of their wealth. That is not theory. That is history repeating itself in real time. And in the institutional world, large funds are openly warning of a coming capital war, a period where nations weaponize currencies, sanctions, and financial flows. When capital becomes political, neutral assets become priceless. Now we arrive at the contradiction that few are willing to discuss. If the global economy were truly stable, bonds would be rising, confidence would be returning to sovereign debt. Instead, the opposite is happening. Demand for long-duration debt remains fragile, and foreign buyers are reducing purchases in several major markets. The asset that once defined safety, government bonds, is losing its psychological dominance. Gold is not rising in isolation. It is rising because trust in the alternatives is eroding. This is where the system breaks, not with a crash, but with a migration. Investors do not flee overnight. They shift gradually, then suddenly. A portfolio adjustment becomes a trend. A trend becomes a stampede. Silver sits at the center of this transition. Its industrial nature ties it to economic cycles. Its monetary history ties it to currency fear. When uncertainty rises, silver becomes unstable because it is pulled in two directions at once. Gold does not suffer that identity crisis. Gold has one purpose: to exist outside the system. And that is why traders are selling silver to increase gold exposure. Not because silver has no future, but because gold has become the ultimate collateral of distrust. Now we must confront the final verdict. The world is entering a new monetary regime. Not announced, not declared, but unfolding quietly through price signals, reserve allocations, and capital flows. The last time this happened on a global scale was the early 1970s, when the link between gold and the dollar was severed. Inflation surged. Commodities exploded. Real wages stagnated for years. But today's system is far more leveraged, far more interconnected, far more fragile. When currencies weaken in such an environment, adjustments do not take decades. They happen in months. Time itself becomes the enemy. Settlement delays matter. Liquidity windows matter. A week of volatility can erase years of stability. Holding cash in such a world is not neutral. It is a position, a wager that the system will stabilize before purchasing power erodes further. History suggests that such wagers rarely end well. You are not witnessing a normal commodity cycle. You are witnessing the early stages of a monetary transition. The selling of silver by gold traders is not a random rotation. It is a signal, a small fracture in a structure that is held for decades. And when structures fracture, they do not warn you twice.